Hey everyone, welcome back to Bonds with Bunt. This week we've got a lot of moving pieces. Inflation came in a little hotter, GDP looks softer, housing showed strength, and bonds are sitting at a key level that could impact rates. So instead of reacting to the headlines, today I wanted to break down what actually matters for buyers, sellers, and realtors right now, and why this may be a window people don't want to miss. So let's start with inflation. The Fed's preferred inflation report, PCE, came in slightly hotter than expected. Headline and core both rose 0.4% for the month. Year over year, headline is 2.9% and core is 3%. Now on the surface, that sounds like bad news. But here's what most people didn't see. A noticeable piece of that monthly increase came from streaming services. Yes, that's right, streaming services like Netflix and Disney. Subscription price hikes, that's what it was. Streaming prices almost jumped 20% in December. That alone added roughly 0.1% to the monthly inflation number. That's likely a one-time bump. It'll stay in the yearly numbers for a bit, but it probably won't keep pushing monthly inflation higher. Now let's talk shelter. Shelter is still running around 3.3% year over year, but real-time rent data is showing cooling. That means inflation data is still lagging what's happening in the real world. If shelter catches up to reality, core inflation could drift closer to the mid 2% range. Bottom line is long-term inflation trend is still moving in the right direction, and that's what the bond market cares about. So now let's look at GDP. Fourth quarter GDP came in at 1.4%, which was below expectations. But government spending dragged down that number because of the shutdown. Private demand was actually solid. Consumer spending rose 2.4%, so this wasn't a collapse. It was more of a temporary drag. That's important when clients hear GDP slowed and assume something bigger is wrong. Now let's talk housing. New home sales were strong. November jumped 15%. December dipped slightly, but overall, we're still at the strongest pace of sales in almost 4 years. There are about 472,000 new homes listed for sale, but only around 123,000 of those are actually completed and move-in ready. That means real supply is much tighter than the headline suggests. Builders pulled back over the past year, inventory isn't flooding the market, and here's the key. Rates do not need to crash, they just need to move slightly lower. And when they do, buyer activity picks up fast. So mortgage applications are already stabilizing, refinances are jumping. Demand doesn't need to explode to push prices higher, it just needs to improve. What's the biggest risk right now? Waiting for perfect conditions, and then competing with more buyers later. Mortgage bonds are sitting right at a major ceiling right now. If they break above that, there's room for rates to improve further. Inflation is gradually cooling underneath the noise. Shelter is lagging reality. Growth is slowing but not collapsing. That combination keeps the door open for lower rates later this year. It's not guaranteed, but increasingly possible. Here's what I'd be telling buyers right now. Rates have already improved from recent highs. Inventory is tighter than it looks. Demand is starting to quietly return. Waiting for rates to drop a lot might mean higher competition and higher prices later. Buying now doesn't mean that you're stuck. If rates fall later, you can refinance. But if prices rise while you wait and can't go back and buy at today's value, that's the difference. As always, if you want to run updated numbers or game plan strategy, please reach out. I'll see you next week on Bonds with Bunt. Thanks.